Welcome to the second part of ScarletToBlack's November topic, which is student debt. And so this section is going to go over loan types. And so a couple things about student loans is that they can be issued by the federal government or private institutions. Both of them require the repayment of the loan plus interest, and loans issued by the federal government, often called federal student loans, are typically much more financially advisable than private loans. And so more about common federal student loans. There are direct unsubsidized loans or direct subsidized loans. And so going to direct subsidized loans, these are available to undergraduate students who demonstrate financial need as determined by the FAFSA. The university determines the amount you can borrow, and the U.S. Department of Education pays the interest while you're in school at least half time and the first 6 months after you graduate. If you are able to get a postponement of those loans, they'll also pay the interest during those periods. A little bit about direct unsubsidized loans, on the other hand, is that they're available to undergraduate and graduate students, and they don't require you to demonstrate financial need. The university again determines the amount you can borrow, and you're required to pay the interest on your loan during all periods. You don't get a grace period. The interest will accumulate if you choose to not pay interest while in school. Other types of loans include one, a personal loan. This can be issued for many reasons. They're unsecured, so there is no collateral. And so these can be expensive, and you will need income verification and proof of assets worth at least what is being borrowed. And the best rates are secured with a well-established credit history. Another type of loan is a credit card. And so each transaction on a credit card is equivalent to a small loan. If the balance is paid immediately, then there is no interest charged. However, any unpaid debt has interest added every month until it is paid off. Penalty rates can also be applied if a borrower misses a payment. So these can get expensive if you're not paying your balances in full. And another thing is that often rates are displayed in APR, which stands for annual percentage rate. Another type of loan is a home equity loan. And so this includes borrowing against the equity of one's home. In other words, how much one owns of their own home. For example, if someone has paid $40,000 on their home, they can borrow up to that amount. Or if the house value has increased by a certain amount, they can borrow up to that new amount. The interest rate is much lower compared to a personal loan. Also, something to note, it's tax deductible if the money borrowed is used to buy, build, or substantially improve the taxpayer's home that secures the loan. A big thing to take note of, however, is that should a borrower default, they can lose their home. And so remember, home values don't just go up, they can also go down. And so that is all on this section of loan types. The next video is going to talk about paying off loans